Aloha and welcome back to the week that was. I'm your host, Colin Edsman. Aloha and welcome back. Aloha and welcome back. Yeah, alright, sounds good. Welcome back to the week to come. I am your host, Colin Edsman. Yeah, alright, cool. And I'm pretty sure this is going in the background, so. Hello, everybody. Let's get started. I am not a financial advisor, and this podcast is for informational and educational purposes only. The content discussed here is not intended as financial, investment, tax, or legal advice. Always consult with a qualified professional before making any financial decisions. Past performance is not indicative of future results. All opinions expressed are my own. Aloha and welcome back to the week to come. I am your host, Colin Edsman, and this is your weekly market outlook. I hope you had a great weekend. I hope you tuned in Friday. There was a lot of stuff that happened last week, and this coming week, we're going to see just as many fireworks, most likely. Futures have already opened up. We got lots of things to discuss. We're going to go over, let me just double check. We're going to go over how the market futures opened, what we're looking for as far as outlook this week. Is this a sell in May situation? Looking for also some opportunities out there. Bitcoin, bond market. And if you have some questions, we can get to those at the very back of the pod. But until then, please just hang out, throw your comments in the chat. Maybe I can get to them during the podcast if they're relevant to what we're talking about. But with that said, let's get started. So the macroeconomic calendar is data driven this week. Monday, we got China, Japan, GDP data. Tuesday, Canada, CPI, UK labor market. Wednesday, Fed, April, FOMC minutes. Thursday, US flash PMIs, Australian job data. Friday, UK retail sales. The big picture for the week is markets are pricing in early stage geopolitical stability, with US-China trade optimism helping Asian assets. But oil remains elevated. It popped off over 100, topped off at 110 on the futures. We can get into that in a little bit. Due to the ongoing Middle East tensions and the Strait of Hormuz concerns. Still closed. Surprise, surprise. Spoiler alert also. Inflation expectations stay sticky, and any dovish tilt in Fed minutes could ease bond yields. We can get down that road as well. Hawkish tones would keep some pressure on. Also going on this week's, NVIDIA takes center stage. So we have the earnings from the biggest company on earth. 5 trillion, probably 5.5 trillion worth at this point. So we could see something good out of it and then the markets go with it. Or who knows? NVIDIA might do well but not smash their earnings and we get a bit of a downturn. But we can take a look at NVIDIA when we get there. Other names that have earnings this week, like Home Depot on Tuesday, Walmart Wednesday, Analog Devices and Intuit on Friday. So some of the key themes to watch this week, it's hard to miss, obviously, geopolitical and oil. Any progress or setbacks on US Iran talks for Hormuz shipping will swing energy prices and inflation hedges. A de escalation would be the biggest positive for risk assets, but I'm not I'm not going to be hopeful. We're going to have to just keep our eyes open. Like we talked about Friday, we still got more momentum coming in for SpaceX IPO, less than 30 days at this point. Roadshow and S1 filing buzz continues. With this, could start pulling liquidity later in May, early June. But the hype supports space/tech sentiment. So we could see some movers in other places, not just with SpaceX. We got Rocket Lab, of course. Who knows? Bitcoin and crypto holding pretty steady. I mean, when it opened the futures, it dropped down under 77,000, but I think we stick to that 76 to 82,000 range for the week. We'll deep dive into that in a little bit as well. ETF flows and regulatory tailwinds remain supportive, but macro volatility could keep it range bound, 78 to 85K. Well, that's a little bit more bullish than I just said, but I saw the futures open and it didn't work out so well. Unless Nvidia sparks some risk on move. I'm not quite sure how we could do that, but we can deep dive that into later. Precious metals as well and bonds. Silver and gold still stay a bit as hedges. Watch 10-year yields and any relief that could boost equities. But the bond market is really going to be a big part of this segment because no sense spoil it. We'll get there. But the overall market tone is cautiously optimistic with some volatility. Sounds like a spicy dish, not so plain Jane of a week. We're getting something caliente out of it. Who knows? It's not no mashed potatoes this week. We're getting some tacos, guacamole, maybe a little bit of cheese. Cautious optimism is delicious, but it hits back, right? Especially with the volatility coming in. Tech and AI names lead this week. Defensive as energy could rotate on headlines. Small caps and internationals, especially Asia, may benefit from trade thaw signals. This week is about confirmation of signals. Does the economy and AI engine keep humming despite sticky inflation? Position accordingly, right? Stay diversified, still the biggest theme this year. Don't overreact to any single data point or tweet. Take it in, digest it, then react to it. No sense just being agitated, then pulling the trigger too soon. All right, so let's get into how the futures opened up. I'm going to pull up a chart for you, and then we can double check how the futures opened to the minute rather than how I played this out earlier. Thank you for sticking around with me so far. I hope you're having a great evening or early morning, depending on where you are in the world. Currently, it is 8:13 p.m. Hawaiian time. I'm enjoying this mixed colored shirt because honestly, I don't know what this week's going to look like, so I went with both colors. All right, here you go. So as you can see, this S&P 500 futures opened red. Not terribly red, right? The VIX is elevated up 6%. The SPY's down 6.2%. NASDAQ opened up at 1.54%. Dow Jones down 1.07%. And Bitcoin down 1.7%. Currently trading at 76,836. Now let's take a little bit of a look and see if we're getting any kind of retracement back from the evening. That box. I was absolutely wrong about where we were going to stop. It's still going. But if we're going to take a look at this real fast, as you can see, we got 1, 2, and 3 bottoms here, right? So those are 3 areas at the 734-ish range, 730 range, that we could see that it's testing it and it doesn't want to break through that. So unless we get some absolutely terrible news, even worse than we already have, I think we're going to stay above that. So I think what we're going to be doing this week is most likely trading up a bit and then testing that 734 range. But this is the 3rd time it tested it. Maybe it's done, right? We got a lot of volume going on here because it was fighting up in here. We're going to back the candles up. Let's give me the hour. Okay, here we go. So this is where we opened up the futures. Hold up. None of those are futures. Ah. That is not what I'm looking for. Still not it. Ah, there we go. And we're back. There we go. Awesome. This is the actual futures. So how are we trading here? So yeah, so the futures have got us at 73.80 currently trading sideways after it opened up on the red side. Right, this was about the time we opened. Poof, down, and now we're sideways. I'm not quite sure what we're gonna do because this is the last time we hit it. Right? Are we gonna stay here? Are we gonna go up from here? We're gonna have to watch how the overall next 12 to 24 hours go, and then we can see whether the rest of the week is going to start to be a downtrend. We were seeing some outflows of some major companies like Microsoft by some of the biggest holders of those shares, just completely selling positions. So I'm not quite sure what we're looking for as far as this week goes, but as always, we're going to keep our eyes on it and do our best to adapt, right? It's all about adapting to the conditions we're looking at with as much data as we can gather about the whole situation. All right, so equity index futures cautiously grind higher. S&P 500 futures. Oh, okay, just double checking. Hi. Hover around 730, right? Like we just looked at. They've been resilient, but show some overnight softness on lingering inflation and oil concerns. NASDAQ futures reflect NVIDIA sensitivity, lighter positioning ahead of Wednesday's report with potential for big swings. I'm going to do my best to try to get the NVIDIA earnings live if they're going to do a call of some sort, because why not? I want to watch that. That's going to move the entire market, and that's super important to the entire global economy. NVIDIA's got a 5% global market cap, basically. 20% on the S&P 500, if not more at this point. Dow Jones is a little bit more on defensive on the futures side, tracking broader economic resilience signals. Expect futures to trade kind of in a choppy range as we're looking at. Strong Nvidia beat could spark a breakout towards fresh highs on the S&P 500. Who knows? We could push 7,500 or higher depending on how Nvidia does, which is kind of a bonkers thing to think about, that one company has this much positive or negative movement on the market itself. So some disappointment or hawkish Fed minutes could we could see some quick downside probes towards the 7,300 support. Like we gotta watch that. That's kind of the floor we're looking at, because if it breaks through that, we could get back down to 7,000 just like that. Overall bias leans mildly constructive if earnings validate the AI narrative, but higher oil and yields keep a lid on positive upside. Oil futures, yeah, they're elevated. They opened up 103 to 107 range, with Brent elevated similarly. The market is in a backwardation signaling near-term tightness. Strait of Hormuz risks and stalled US-Iran talks keep a massive risk premium baked in. Any escalation or positive de-escalation news could cause violent moves. So please, if you haven't taken some profit, maybe do a little bit. I'm going to do a little bit of sitting on my hands again this week, sell some covered calls, and see where this week's goes as overall geopolitically and on the big macro side, because that could really affect a lot of the holdings that I have, and of course Nvidia. If all of a sudden we get a wild AI narrative turnaround, who knows what the market will do. But it's bullish on this week's bias unless diplomacy suddenly heats up, and it's going to. Analysts eye potential tests towards 110 to 114 on the crude oil futures, with fresh disruptions, while a peaceful resolution could see a fast $8 to $12 drop on the futures. Watch inventory data and any tanker/shipping updates daily if you're going to trade this market. Oil futures will be dominant on the macro sentiment. Treasury futures and rates. Okay, so we have to keep our eyes on the market. I'm glad we're going to get into this for a little bit. This might be a little bit on the boring side if you're not into this fully, so by all means, go take a break. Now, let's talk about the bond market for a second. The Fed minutes are sort of in focus here. The 10-year Treasury futures are under pressure from the recent yield spike. 10-year cash yield of 4.46 to 4.59%. That is huge yield. I don't know how we can afford to pay that. Rate futures, Fed funds, show very low odds of near-term cuts. Higher for longer is the base case at this point, with some pricing and possible hikes if inflation stays on the sticky side. Now, as I was covering a couple weeks back, everything felt expensive already. Now, we're still feeling on the expensive side. There are companies that are obviously doing great, but the market itself as a whole just feels way too high for the overall crisis that we're dealing with. But key event, of course, with Wednesday's FOMC minutes, dovish language could bring bond futures a relief rally and ease equity pressure. Hawkish tones could push yields higher and weigh on risk futures. Futures are pricing in a prove it week. We gotta watch now, with volatility in the wild card that could override literally everything. If equity futures hold steady with Nvidia earnings and bond futures stabilizing, we could see a constructive grind higher. But any geopolitical flare or earnings miss will amplify moves real fast. Futures traders are positioned defensively but ready to chase strength. With it, this is where real money flows first. Watch the overnight action Sunday night into Monday for opening bias. We're currently in that trading area now. It's not 10 o'clock here, which is 2 o'clock or 3 o'clock in New York City, and that's when things sort of pre-open, or we got the overnight. So I like kind of looking at that too. People are waking up in different countries and starting to trade after they've kind of digested what the futures market has shown them. Now everybody reads these tea leaves differently. That's why we get up downs. Everybody thinks about things differently. So everybody has to kind of digest, and then they kind of put out for the week. Personally, I don't really quite know yet. I'm going to do more looking overnight as I get through this podcast and get through the information for you. Then we can kind of see together what the evening will bring and the first opening hours will bring tomorrow morning. But I'm cautiously optimistic. I would consider myself more of a pragmatic bull. Now, let's get into the possible sell in May situation and some information about it. We've looked at the calendar, earnings, and the futures. Now let's tackle one of the most debated seasonal questions every spring. Should you sell in May and go away in 2026? The old adage suggests stocks tend to underperform in May through October compared to the stronger November-April periods. Historically, there's some truth to it, but the data in the recent years, and especially right now, tells a more nuanced story. So, here's a historical case. Since 1950, the S&P 500 has averaged roughly 7% gains from November to April, but only about 1.7 to 2.1% from May to October. Midterm election years like this year have been even weaker on average. For the last 6-month stretch, negative in about half the cases with modest average losses. Sounds compelling, right? But with blind adherence has some costly mistakes lately. Look at where we are right now. Crisis is not done. Crude oil futures are elevated. Stock market is still up. So we're not getting the traditional response and reactions that we usually get in these situations. People aren't piling into gold or silver. The stock market isn't bleeding out because of the overall costs of energy going up. Who knows what could be happening? But recent performance will kind of prove or disprove why the sell in May looks outdated this year. Over the past 10 to 12 years, May through October returns have been much stronger, averaging about 5 to 7%, with positive results in most periods. May itself has been positive in 12 of the last 13 years. We're coming off a massive April, 10% plus, with the S&P 500 near record highs. Strong Q1 earnings momentum, AI tailwinds, and resilient growth are supporting the bulls. Many strategists may say blindly selling now would mean missing out on potential upside. Like we talked about Friday and earlier in this pod, We have SpaceX IPO coming out soon too. That itself could be extremely bullish for this coming June and help the S&P 500 grind higher on rocket themes all summer. Who knows? Algorithms don't take summer vacations, and structural drivers like AI, space, slash tech IPOs, on chain growth don't follow a calendar. Sticky inflation, oil geopolitics could create summer volatility. Midterm years have seen weakness before, and August through October is often the roughest patch historically. A healthy consolidation or a pullback in May wouldn't be surprising after April's huge 10% plus surge. So, here's a takeaway: don't sell everything and go into cash. The people who have been doing that have been getting their faces kicked in, just sitting there, missing out on historical moves. It's rarely the winning move anyway. In today's environment, instead of use sell the May, as a risk management reminder, trim winners, rebalance, rotate into defensives or hedges if you're overweight, and stay selective. Often on quality earning stories, watch for Fed minutes and oil. Focus in those areas and be ready for dips to buy rather than a mass exodus. That is a fear based response. What are you afraid of? A little bit of downturn? That's what we're in here for. That's why we play the game. Get selective, get defensive, rebalance. Look for things that might be a little bit overweight. If your portfolio tends to swing a lot with the markets as we're dealing with, it's only going to get worse. So it might be time to trim the winners and reconsolidate that or diversify that into something that could be defensive against the overall market that we're dealing with. The market doesn't care what month it is. It cares about earnings, rates, and geopolitics. In 2026, with powerful secular themes in play, staying invested with discipline looks much smarter than following any old ridiculous rhyme. So as far as selling May goes, who knows? I'm not going to do that. That's ridiculous. All right, next up, some catalysts for the week. So it's going to trade sort of softly to down probably the first part of the week. But as we covered on the calendar, the earnings, future positioning, and the classic sell in May, now here's the fun part where the real money can be made. Here are the top opportunities I'm watching for this coming week. 1. NVIDIA earnings. That comes in Wednesday after close. This is the event of the week, period. Expectations are sky high. Analysts are eyeing 78 to 80 billion or more in revenue, up 79% year over year, with massive data center and Blackwell demand. Bull case: beat plus strong guidance equals fresh leg up in semis, AI infrastructure, and the broader tech rally. Opportunity: play the pre-earnings volatility or position the supply chain, memory chips, power slash semiconductors, data center plays, that sort of thing. Strong print could reignite the AI theme that's already just booming. So we could just get a cool off the first couple days and then pop back off. Now, personally, I'm not looking into buying any more positions this week because a lot of my active portfolio is AI themed, tech themed, semiconductors. So I'm just looking for hedging at this point, right? Putting some cover calls, protecting myself, taking some profits, and maybe moving some things into metals like gold. Gold is looking a little bit on the cheap side to me. Silver is swinging on the volatile side, and I have some hard silver, so I'm not looking to necessarily trade that. Two, energy and oil complex, geopolitical premium. There's an opportunity there. With oil futures elevated and Strait of Hormuz risks lingering, energy remains standout. Opportunities like traditional oil and gas producers, oil services, and especially AI energy crossover in some way. Power generation, gas turbines, nuclear/uranium, or even data centers. Those are great opportunities I'm looking at this coming week. I might position it a little bit more into VG. That's my energy play for the moment. I've got long leaps on, just leaps. But I've got some long calls on next decade that I'm also looking at. It's gone up a bit. I got some $10 calls for way out in 2028. So those are already looking nice and juicy. Maybe I'll trim a little bit of there. I'm not quite sure because if we get a de-escalation situation going on, Nvidia grinds higher, those energy stocks, at least the volatile ones around oil, could come down a bit. So I have to keep my eyes open. Clean energy names tied to AI power demand, also looking interesting for any kind of dip. Energy has been rotating strongly this year. This week's geopolitics or inventory data could spark some moves, so keep your eyes there. 3. Industrials and materials. The real economy rotation. Any money rotates out of pure AI hype into things that actually build and power the actual future. Heavy in electro equipment, construction, industrial machinery, and materials, especially copper and metals for data centers and electric vehicles. Defense and aerospace also benefit from the broader geopolitical backdrop. So you got to keep your eye on the metals that people use to build other things. It's extremely important to this overall future that we're looking towards. Energy, machines, robots, computers, AI, that all needs actual materials. So I like buying pieces of things. I might consider a copper play, and if I come up with one that I would like to share, I'll bring it up to you sometime in the week. If not, I'll talk about it on the week that was this coming Friday. Here, there's number 4. Thematic, longer term plays still in focus. SpaceX IPO hype, precious metals, crypto and on-chain, retail VC access, they're all still great opportunities this week, depending on the overall AI Nvidia earnings call situation. So the biggest opportunities this week sit in the interaction of AI infrastructure and energy. Nvidia is the kind of binary trigger, but the multi-year themes remain intact. Use any sell in May weakness as a potential entry, not an exit. Don't be trying to trade on a rhyme, okay? Trim, take profits, that's always something we should do. But like I said, these things don't care about months. They care about rates, earnings, overall macro. So stay selective, size positions responsibly, and remember, in this environment, conviction and secular winners beats chasing a headline any day. Now, I'm going to take a quick break. We're going to come back in just 1 minute, and I will see you. And what we're going to talk about when we come back is the current setup entering for this week for Bitcoin. All right, I will be, here we go. Hold on 1 second. All right, I'll be back in 1 minute. All right, welcome back. Thank you for sticking with me and my very glitchy ad. But we have to run our ads from our sponsors, and if you are looking for any kind of relaxation here on the Big Island here in Hawaii, please take a look at the Kohala Salon located at your local Hilton Waikoloa Village. I'm not a commercial person. I'm getting used to it, eh? Give me a little bit of slack. All right, let's get into some Bitcoin news. Now, so this week we're going to start kind of seeing really what Bitcoin has in its pants. Honestly, I don't know if it's going to go up, but if it kind of stays where it is and trades a little bit sideways, that's just more of an assurance that we found a great support area and we can continue to dollar cost average if we're looking for more Bitcoin exposure, more cryptocurrency exposure. You don't have to directly buy the asset. You can always go through ETFs like HODL by Van Eck, or you can go through on-chain technology like Node. It really doesn't matter, right? As long as you're dollar cost averaging into the theme, it's good for the time that we're sort of trading sideways. Bitcoin is consolidating between 77 and a little bit lower and 81,000 zone. After a volatile stretch, it briefly pushed above 80K and 81 mid-May on ETF inflows and risk-on sentiment, but pulled back towards 78 to 79,000 area amid hot CPI reaction and broader market chop. As we head into Monday, or Monday it is for you already, because here it's still Sunday, so maybe I'm talking to you in the future. Bitcoin is hovering where we are right now, about 70, 80,000, with futures showing some overnight caution, key levels, and technical outlook. So we have a strong support area somewhere at 76,000. It's a critical zone. A break here could accelerate towards 74, 75,000, even 70. Who knows? Bitcoin's a very volatile asset, so you have to keep your head on a swivel as a holder, or even as a holder of exposure on the side. Resistance. We're looking at about 85,000. It just doesn't want to pass that. That's sort of where the ceiling is. I'm going to bring up the chart on Bitcoin, and I'm going to show you kind of what I was talking about the other day. Because it wasn't that it was bad, it just doesn't look like it's going to break through that area. We're going to give it a moment here. Bitcoin is always going to be moving forward a future asset. It is going to be around. We're seeing projections of $1 million value per coin by 2040. So it's your job as an investor to pick a little bit up over time and stay invested. This is just like any kind of long-term hold asset. Yeah, you can trade it if you want to, but honestly, Bitcoin is for the long. Like, why would you touch it so much? All right, here we go. Like, trade the exposure. Don't trade the actual asset. That makes no sense at all. What you're trying to do is get more of it, right? It's nowhere near what it should be valued at. Who knows? We could see a 200,000 Bitcoin run towards the end of the year. I've seen weirder. But you can see it's still in my orange box here. Orange for many obvious reasons. But this is the kind of resistance support floor as of recently. As you can see here on the chart, it's gotten as low as 64,000. Almost just below 65,000, and that's the most recent support area. But as you can see on the RSI, for at least the 1 hour candles, we're a bit on the oversold side. So I can see us returning to the means about 80,000. But as you can see here on the top, we've got 1, 2, three tops here on roughly 82,000, and we're not going to get through that anytime soon. And that's okay, because that means we can consolidate more, right? You never have enough of it. No one does. We're seeing Michael Saylor still buying more and more Bitcoin, right? We always buy more. That's the object of the game. But you see here, it kind of tapped this 150. Nope. It tapped the 200-day moving average and then came back down. Now we're here at the 100. Nope. I need to know. Okay. So now we're sitting comfortably at the 150. So we could see a revert back to the 200 from here, or we could see a drop back to the 50, or even the 100 down here at the bottom. But it really depends on NVIDIA's earnings, like I was talking about earlier, because if that doesn't go very well, everything from AI to crypto, tech could see a bit of a correction this coming week, which is healthy, unless you bought at the top. Then it's a very unhealthy move. All right. Now, let's continue on. So drivers this week, we have ETF inflows. The big story we saw is a record 635 million inflow on May 13th. That was the largest since January, but prior weeks had strong multi-billion-dollar inflows. Watch daily flows closely. Sustained buying from BlackRock's IBIT and others provide a structural bid. You can also look to HODL. You can also look to anything thematic like semiconductors, on-chain like Node. That's kind of where I watch on a small standpoint. I like that better. Macro and Fed minutes is coming Wednesday is also a big driver. Dovish tones could boost risk appetite in Bitcoin. Hawkish or higher for longer signals could weigh on the long side equities. Strong AI print equals broader risk on tailwind for crypto. Weakness could drag everything. Oil and geopolitics support Bitcoin's digital gold narrative. De-escalation might shift flows back to equity. So we could see Bitcoin grind higher because of the overall oil crisis, because it's sort of like a hedge to some people. Bitcoin enters the week in a prove it consolidation area. The showings relative strength, but holding above 76k despite headwinds. But it needs a catalyst, either ETF inflows resuming strongly or macro relief to break towards that 85k or higher. If we could break that, we would be in great shape. We could see 90k by the end of the month. Who knows? But we really need to see what this week does. So eyes on NVIDIA earnings. If you're a long-term holder in adoption and regulatory clarity, dips towards major support like accumulation zones are good areas to look towards. Short-term traders should stay nimble around earnings and Fed minutes. Volatility is guaranteed this week, but the structural tailwinds remain intact. We're looking at institutional ownership as well as on-chain growth. People have to buy this, right? So you need to see where people are putting their money. It's important to watch the inflows for any asset you're considering to buy more of or get a position in. Because if nobody's buying it, why should you buy it at this point, right? That could be a signal to wait and maybe buy a little bit lower, or just buy less than you were considering. Opportunities are still out there this week because of the overall consolidation. I'm looking at if there's some decent dips towards some support areas. Maybe I'll pick up a little bit more. But it's inside my orange box, so I'm picking up a little bit less. I'd rather it come under that 70,000 range, then I'll consider picking up more. All right, let's touch on bond markets a little bit more. Oh, I don't know how to express how important the bond markets are. Uh, it just sounds like a boring topic. So, as I got into trading and progressively got better and more knowledgeable at it, the bond market has always been a big theme throughout my learning process. It's the inflation is always the answer situation. I always look toward it, especially the 10-year, to kind of see where things are headed as far as costs for overall goods go. The current levels entering this week, the 10-year yield is hovering around 4.8 to 5.8%, near multi-month highs. 30-year yield pushing 5.05% to 5.15% territory. 2-year yield sitting near 4.10% to 4.20%, reflecting limited near-term rate cut expectations. The yield curve remains modestly sharpened or steepened, but the real story is the sharp repricing higher we saw last week on sticky inflation and energy prices. What are we going to watch for this week? Fed minutes on Wednesday, which is the headline for the week, economic data, UK CPI, US flash PMIs, Michigan sentiment, the whole nine. Oil inflation, oil and inflation transmission. We need to see what the market's going to make more expensive for people. And I'm not 100% sure, or even 20% sure, how much of this inflation potential is priced in. We need to see some de-escalation and some oil retracement before we can really start going full-blown risk on. Because one tweet could turn everything around and all of a sudden the markets are red. Outlook for bonds this week. Let's check out the base case. Range bound to slightly higher yields unless the Fed minutes surprise dovish. The market has already priced out most, if not all, of the near-term rate cuts. So the bar for a big bond rally is high. Risk scenario. If yields push towards 7 points, or, 4.70 on the 10-year, we could see stress in rate-sensitive sectors, real estate, utilities, growth stocks. Here's some opportunity though. A relief move lower in yields would be major as far as a tailwind goes for equities and could spark a broad risk on rotation. Talk about a bull market after that. We could see 76, 78, 8,000 on the S&P 500. I'm not putting my hope on that though, because we don't know how much this is really going to cost yet. Here's the takeaway. Bonds are the adult in the room right now. They're telling us inflation isn't dead. The Fed is in a wait and see mode. And borrowing costs are likely to stay elevated for much longer. Investors, this is what this means for us. Higher for longer is a dominant theme. Quality fixed income still offers decent yield for defense. Any meaningful drop in yields would be your signal that the market is getting more comfortable and could unlock the next leg higher in the S&P and the stock market as a whole. So we're going to keep our eyes on the 10-year yield like a hawk this week because it remains one of the most important variables for the entire market. Thank you for keeping up with that. I know bonds aren't the most flashy and exciting thing to talk about, but once you get into this, and this is a day-to-day thing as far as trading, investing. This is your income driver. You're going to keep your eye on the bond market. It's also important for other investments like real estate, like I said. If this continues to go higher and higher, we could see a 7% interest rate on mortgages, which would be almost impossible for anybody in under the age of 50 to get a home anytime soon because of how the overall economy is on younger homeowners. Now, historically, interest rates have been in the double-digit areas, and the people who lived in that time period, 80s or prior, still were able to buy homes. So the market was still affordable even at that interest rate. Whether that was good, I'm not sure. Most people I talk to now kind of just like blow up on the inside when I say interest rates used to be in double digits at one point. Now, this is before my time, not anything I dealt with. I grew up in a time where the subprime loan crisis kind of squashed a lot of my parents' generation and a little bit of their hopes and dreams. But moving forward, I think this year's theme, and if the summer doesn't move towards space and SpaceX IPO and that theme, I think we're going to get a strong reversal for home buying. We still have the Housing Act moving through the Housing Bill. I didn't look at it fully yet. As it gets more solidified and more popular, I'll cover it a little bit more. But it's important to take a look at it because if that's where the administration is going, then we could see themes in the housing market start to rally soon too. I hold a decent amount of shares of Open Door. I think it's a smart company, regardless of the overall squash down on the price. Open Door is a long-term hold. It's a great company with a great idea, and real estate is sort of what I think about the most outside of trading equities. So let's look at what we're looking at for this coming week's sort of outlook. Before we dive deeper into this week ahead, let's quickly cover some key developments over the weekend. Markets are closed, but headlines kept moving, especially around geopolitics. Oil and positioning ahead this week's big events. Friday's sell-off lingers in focus. Stocks ended the week on a bit of a sour note on Friday. S&P down 1.2%, Nasdaq fell 1.5%, Dow shed over 500 points. Tech and chips led the decline after a strong run. The trigger, surging bond yields, obviously, and oil prices reigniting inflation fears. The 10-year Treasury yield jumped. The 30-year hit a 5.13%. This is the highest close for the 30-year yield since 2007. Now, that was the year I graduated high school. I didn't know diddly squat about what I'm talking about now. How people change. But that was a long time ago. We're talking about almost 20 years since the 30-year was this high. Geopolitics is still a dominant story. I cannot wait to stop talking about oil and Iran and the Strait of Hormuz. But until it's not a strong theme covering the market as a whole, I'm going to keep covering it no matter how sad and how boring oil is. Because this kind of information is what puts money or takes money out of your pocket, out of my pocket. So oil is going to be a big theme this week. We're going to keep looking at it. Brent crude settled around 109 this past Friday, late in the week, but went up sharply on persistent concerns over the Strait of Hormuz and stalled U.S.-Iran ceasefire talks. I can't believe anything they say. Mixed signals from the Trump administration and ongoing diplomatic friction keep risk premium elevated. No major breakthroughs happened this weekend, so this remains a top macro wildcard heading into this coming week. The weekend buzz on Nvidia. We got Bitcoin holding well this past weekend. On the broader tone, traders are digesting the higher for longer, replacing with watching for any de-escalation in the Middle East. This weekend was pretty quiet on news bombshells, but Friday's move set a cautious tone. Markets enter the week extended but vulnerable. Oil and Fed minutes will likely dictate early direction. Use any weakness as a chance to reassess and not panic. Panic is for weenies. There's no crying in the casino. Alright, so that was a long one. And I'm enjoying it. Thank you so much for sticking around with me. Let's bring this pod to a nice, calm close, and we'll recap and do some takeaways from this and see what we got coming up this week. So we've covered the full picture for the week ahead. From macro calendar and Nvidia earnings through futures positioning, sell in May, debate, key opportunities in AI energy and Bitcoin consolidation, bond market tension, and weekend headlines. But here's the bottom line. This week is a prove it week. Nvidia's report on Wednesday is the single biggest catalyst. Oil and geopolitics remain the wild card. Bond market is in control. Watch the 10-year yield very closely. Themes are still winning. Bull market left and right on AI infrastructure, energy, and traditional energy as well, and power for data centers, space and tech momentum, and so on. Overall week's outlook, base case, choppy but constructive. S&P 500 likely trades in the 7,300 to 7,550 range with upside bias if Nvidia earnings deliver. Also Walmart as well. Risk case, oil spike plus hawkish Fed minutes, we could see a 3 to 5% pullback. Bull case, Nvidia blows it out, plus any geopolitical de-escalation, we could see new highs on a broad participation. But don't let the old sell in May theme scare you. Because this market is about staying invested and finding opportunities to diversify, not pull back. These secular trends, AI, energy, space economy, and on-chain growth, are bigger than any single week or seasonal pattern. Stay disciplined, manage risk, use volatility to your advantage, and keep a close eye on oil and Nvidia. So thank you so much for hanging out with me today. One thing I learned this week, actually more specifically today, is I got a chance to use my Meta glasses in a very interesting way. So we have a bit of a dead motor on one of the windshield wipers on our Ford Escape. So I went through some back testing, replacing it with the opposite working motor to see if it's a grounding issue, if it's a wiring issue, if there's a fuse. So we went through all of those checks today, and I had AI with me, taking pictures, giving me feedback, so I don't have to go and constantly look at the manual. It gave me a chance to listen to it, and then it was kind of giving me information about what I'm looking at, so I could ask it questions. It was actually really, really easy. So by all means, please look into some sort of wearable AI. This was a godsend. It cut some of my diagnosing time on the car probably by 75%. So that was what I learned this week or today. use your tech. My God, it's out there. Because at the end of the day, AI and robots, they don't have the human drive, the human need for anything, right? Those are just tools. Those tools can get in the way, but those tools still provide income for somebody. So this tool provided me time to hang out more with my family, to hang out more with you. So because of these glasses cutting down some of the diagnosing time on that repair today, ugh, I'm gonna keep using them. Now I would say I need some sort of glasses strap. It was a little bit on the falling downside because when you're perspiring in an engine bay, the slipperiness of at least this material makes it on a little bit hard to keep on my face. So that's something more of a learning curve for me, but a little bit of an old school glasses strap wouldn't kill me. But with that being said, I want to thank you, and as always, farewell. Take care of yourself. Please invest wisely. Take your profits. Ahoy ho, and I'll see you on the porch.